Hi, this is Byran Knutson, advisor with Cutler Investment Group, and I'm here to do a 3-minute money mile about ESG investing. ESG stands for environmental, social, and governance. This is an approach to investing where we are seeking to identify companies that do not fit a set of criteria. But essentially what we're looking for is to find companies that we believe do not execute best practices in some or all of those areas that I noted, the E, the S, or the G, and remove those from the portfolio. This is most often these days done via an index approach, where, for example, we take the S&P 500 index, a very well-known broad domestic stock index, and we are going to set some negative screens. Negative screens simply mean that we're going to go through and filter based on things like their environmental score, their carbon footprint, how representative they are for certain minority groups, whether that be ethnic-based or gender-based, and/or gender-based, on their leadership, and how they treat their clients, their customers, their shareholders, and their employees. So how does this practically work out? What we have seen these days is, given the volume, the large volume of providers, since there is such an influx of money into this area, which, more money brings more providers, more offerings, that there are some different approaches. One other company might screen out McDonald's, for example, for labor issues, but still, again, keep in Amazon, which, as we know, not trying to pick on Amazon, but they've had a couple of issues in each of those areas. Those providers ultimately have to decide where their thresholds lie and what they're going to include and exclude. You can't exclude everything, or there's no index left to invest in. This type of approach, this approach to investing, has been most prevalent in large caps. However, given again the increased amount of interest and again increased amount of money into this area brings more offerings into areas like bonds, in areas like emerging markets. So there is a wider range of coverage here, and it's getting wider all the time. The good news there is, if there's more coverage, there's more competition. That tends to drive down prices. That has helped to make this area not be quite as potential of a drag on returns as it perhaps was 20 years ago, and has made it more egalitarian with a more standard approach. One other thing that to note is that this type of approach, since it will almost exclusively have no energy in it, will tend to swing one way or another. So if you looked at some of these right now, exactly today, when energy has had this big rally up, it might look like that index is modestly behind. It is very important to make sure you know what you're comparing against, you know how the specific criteria works for the provider or providers that you have in mind, and how you would like to assemble ESG into a portfolio. Are we looking at this being the entirety, or are we looking at this being an aspect inclusive of a more traditional type non-ESG portfolio? Either approach can make sense depending on your situation. Speaking of your situation, if you'd like to talk about this further, please reach out to myself and/or your personal advisor here at Cutler, and we'd be happy to talk over some options. Have a great weekend. Thanks.